Imagine missing Wall Street's expectations by like a massive margin, the kind of headline miss that usually sends analysts into a total
Oh,
panic.
yeah, an absolute sell-off scenario usually.
Right, yet somehow walking away with your bank account stuffed with over $13 million in fresh cash. Welcome in, everyone. I'm your host, and today we're doing a deep dive into the Q2 2026 earnings report for Franklin Covey.
And I'm your resident financial analyst, ready to get into the weeds. And this report, it dropped on April 1st, 2026.
Yeah, and on the surface, it reads like a standard financial update from a legacy leadership and organizational consulting firm. But if you know where to look, there is this fascinating hidden narrative buried in these pages.
It really is. It's wild.
So our mission today, for you listening, is unpacking how this company is actively positioning itself as an absolute essential partner for organizations trying to survive the artificial intelligence revolution.
The contrast here is just staggering between what headline numbers say and what is actually happening inside their financial engine, I mean. You really have to look past the top-line summary to see the strategic shift.
So let's bring the listeners into those numbers. Let's look at the facts from this Q2 report, because if you just read the press release summary, you might assume, well, that this company is stalling out.
Yeah, exactly. So if you look at their headline revenue for the quarter, it came in at $59.65 million, which is basically flat year over year. It barely budged.
Right.
But the number that catches everyone's eye is the earnings per share. The EPS Wall Street had this consensus expectation that they would report a gain of 3 cents per share.
Okay, a small gain.
Yeah, but instead they reported a loss of 17 cents per share.
Wait, hold on. Let's break that down for a second. For anyone listening who doesn't, watch financial networks all day, explain what earnings per share really represents and why a miss like that makes Wall Street so nervous.
Sure. So earnings per share is essentially a company's total profit divided by the number of outstanding shares of its common stock. It's basically the ultimate report card for investors.
Because it shows profitability on a per-share basis.
Exactly. Wall Street analysts build these incredibly complex models to predict this exact number. So when a company misses that expectation, especially swinging from an expected profit to a reported loss, it usually signals that costs are completely out of control.
Or that sales have just fallen off a cliff.
Right. It's the kind of headline that makes investors immediately hit the sell button.
But you mentioned their bank account is actually stuffed. So where is the hidden story here?
The hidden story is in the cash metrics. If you look at their Adjusted EBITDA, it actually nearly doubled to $4.1 million.
Wow.
And even more dramatically, their free cash flow swung from a $3.6 million loss in the same quarter last year to a massive $13.2 million gain this quarter.
Okay, we need to do another quick translation here. Because how do we get from a terrifying EPS loss on paper to millions of dollars in the green? What exactly are Adjusted EBITDA and free cash flow?
Well, if you strip away the accounting rules, taxes, depreciation, and non-cash expenses, you want to look at the pure operational cash a business is generating from its core activities. That is what we call Adjusted EBITDA.
So it shows if the actual business model is working before the accountants get involved.
Precisely. And free cash flow is even simpler than that. It is the actual hard cash left over after the company has paid all its operating expenses and maintained its capital assets. It is literally the money hitting the bank vault.
So the reported profit on paper is a loss, but the physical cash hitting their bank account is surging. How does a business actually pull that off? What are they doing differently?
The answer lies in their working capital, right, and specifically how they manage their accounts receivable. In simple terms, they got incredibly efficient at collecting the money they are owed.
Okay, so tightening up the collections.
Yeah, they tightened their billing terms and actively brought the cash in the door faster. But the real engine, the big driver, is a metric called invoiced amounts. That grew by 5% overall for the company.
Wait, invoiced amounts, meaning they are billing clients for future work.
Exactly. They are signing multi-year contracts and invoicing clients for these big upfront commitments.
Oh, I see. This feels like looking at a restaurant that seems, totally empty today because no one is sitting at the tables.
Right.
But behind the scenes, you realize they just collected millions in upfront cash for massive corporate catering contracts for the next 2 years. The dining room looks empty to a casual observer, but the bank account is completely stuffed.
That analogy is perfect. That mechanism is exactly what drives their massive free cash flow number. When they sell a committed multi-year service contract, they invoice the client and they collect the cash.
But standard accounting rules say they can't report it all at once.
Exactly. They cannot report all of that cash as revenue on the income statement right away.
Yeah.
They have to recognize it slowly, month by month, as the service is actually delivered to the client.
So the headline revenue looks flat today because of those accounting rules, but that surge in cash flow tells you the sales engine is actually humming loudly in the background.
Humming very loudly, yeah.
So if the engine is humming, where is the horsepower coming from? Like, who is actually signing these massive upfront contracts?
The vast majority of this growth is coming from their Enterprise North America division, which is crucial because that makes up over 50% of the company's total sales.
Okay, that's their biggest segment by far.
Yeah. And in this division, those invoiced amounts we just talked about, they grew by 7% for the second consecutive quarter. And if you dig a little deeper, the core growth is actually 10% when you exclude their government business.
Let me stop you there for a second. Why exclude the government business? Did they lose a bunch of federal contracts or something?
No, not at all. It's a standard macroeconomic hurdle. Whenever there is an impending change in the federal administration, federal agencies tend to freeze.
Oh, right. Budgets get locked up.
Exactly. Regardless of which political party is taking over, agencies delay their discretionary spending until new budgets and priorities are finalized.
Yeah, and speaking of that, the source material specifically mentions some market uncertainty regarding what the incoming Trump administration might do with education funding. And just as a quick note for our listeners, we're not taking any political stance here. We're strictly looking at this impartially as a statement of market uncertainty.
Right, absolutely. It's just an external variable affecting the timing of contracts. It is not a reflection of demand for the product itself, which is why focusing on that 10% core growth in the private sector is the real signal of the business's health.
Okay, so the private sector demand is strong. But how do we know this isn't just a temporary spike? I mean, how do we know they won't be struggling again in 6 months?
To understand their future, you really have to look at a line item called deferred revenue. In Enterprise North America, their billed deferred subscription revenue grew a highly impressive 16%. Up to $59.3 million.
16%, wow.
And furthermore, 62% of their total revenue is now locked into multi-year contracts.
Let's make sure we have a clear picture of deferred revenue. Based on our catering analogy earlier, this is the cash they've already collected for the weddings they haven't catered yet.
That's it. Think of deferred revenue like a massive financial reservoir. The water, the cash in this case, is already trapped behind the dam.
Right.
It is totally secured.
So they don't have to go out and hunt for it next quarter.
No, they simply need to open the gates over the next 12 to 24 months and let that revenue flow onto their income statement as they deliver the contracted services. They've essentially pre-booked their future success. It creates this massive runway for fiscal year 2027.
Wait, hold on. Let me push back for a second here. Because everything you're describing, locking clients into multi-year contracts, collecting upfront cash, building deferred revenue, isn't this just the standard SaaS playbook?
Software as a service, yeah.
Right. You sell a cloud subscription, you lock a corporation in for 3 years, you collect the cash up front, and then you basically forget about them while the software just runs in the background. Is Franklin Covey a leadership consulting firm just pretending to be a software company?
That is the exact assumption many analysts make. And CEO Paul Walker actually directly countered this on the earnings call. He was emphatic that their model is fundamentally different from standard SaaS.
How so?
Well, with a typical SaaS product, a company is selling software usage, right? If the client buys the licenses and literally nobody logs into the portal, the SaaS company still gets paid.
Yeah, they don't care. They got their money.
Exactly. But Franklin Covey's model is fundamentally about tying their technology, their content, and crucially, their human advisory services to actual, measurable, enterprise-wide performance outcomes.
So they aren't just selling a login credential and walking away. How does that practically differ from software?
A software tool just sits there waiting to be used. Franklin Covey's model requires active integration into the daily workflows of a company. Their technology platform is just the delivery mechanism.
So what are they actually selling then?
What they're actually selling is behavior change at scale. They provide the human coaching and the frameworks required to make an entire workforce shift how they communicate, how they prioritize tasks, and how they execute their goals.
You know, if you're listening to this and worrying about how fast the corporate landscape is shifting, this is where the story gets incredibly relevant to you. Because why are massive corporations suddenly so desperate to buy behavior change right now?
It all comes back to artificial intelligence. In the report, Paul Walker highlighted this fascinating paradox. The conventional wisdom is that, as AI takes over, human skills become less valuable.
Right, the robots are coming for our jobs.
Exactly. But he argues that AI is actually increasing the premium on human leadership and execution.
That feels completely counterintuitive. I mean, if an AI can do my job, why is my human leadership suddenly more valuable?
Because as AI automates routine tasks like drafting emails, analyzing basic data, writing standard code, the baseline of productivity rises for every single company in an industry.
Right, everyone gets faster.
But because everyone has access to that exact same AI baseline, the technology itself no longer sets a company apart.
Huh.
If every bank has the same AI analyzing risk, the AI isn't an advantage. It's just table stakes. So the real differentiators for an organization suddenly become human judgment, trust, high-level collaboration, and the disciplined execution of a strategy.
There is a specific anecdote from the report that perfectly captures this paradox. A large tech company recently selected Franklin Covey to help its CEO transform their organization to an AI-enabled operating model.
Yeah, I saw that.
But wait a second, I have to push back hard here. Tech companies are the ones building the AI. They employ the smartest software engineers on the planet. Why on earth would a Silicon Valley giant need a leadership consulting firm to figure out how to use the very technology they are creating?
Because the technology itself is the easy part.
Oh, really?
Yeah. Changing collective human behavior to actually adapt to and utilize that technology is incredibly difficult. Think about the psychology of the average worker right now. When a CEO announces an AI-enabled operating model, the average mid-level manager instantly hears, "I am going to be replaced."
Oh, absolutely. Fear sets in immediately, and silos deepen because people want to protect their specific knowledge, right?
Exactly. The engineers can write the APIs, they can deploy the large language models, but they cannot write a script to make an anxious defensive workforce willingly train the AI that they believe is coming for their jobs.
That's a great point.
That requires profound trust. It requires managers who know how to guide a team through massive disruption without losing morale. A tech company might have a flawless technical strategy for AI integration, but successful execution depends entirely on change management.
Because AI cannot replicate trust.
No, it cannot replicate empathy at scale.
Huh.
During times of massive technological disruption, the need for strong human leadership goes up exponentially.
Okay, so the theoretical strategy makes sense. The financial engine is humming. But you don't secure massive multi-year contracts just by talking about trust and empathy. Those can sound like fluffy corporate buzzwords to a CFO.
Okay.
What are they actually doing inside these companies to generate bottom-line results? Like, does this actually hit a balance sheet?
It does. And the earnings report gives us some hard, measurable ROI across different sectors that prove this isn't just theory. Let's look at their education division first. Revenue there jumped 16% to $17.5 million in the quarter. And the driver of that growth is their Leader in Me program. The data shows that schools using this program are 600% more likely to retain their teachers compared to schools that don't.
600%. That is wild. And retaining a teacher is, well, it's an incredible human victory, first and foremost. But it also has a massive calculable financial value to a school district.
Oh, absolutely.
The cost of recruiting, hiring, training, and onboarding new staff is astronomical. How does a leadership program actually keep a teacher from quitting?
It structurally changes the daily operations of a school. It is not just a motivational poster in the hallway, The program teaches students how to take ownership of their own learning and behavior, which fundamentally reduces the daily disciplinary friction that causes teacher burnout.
Oh, so the students manage themselves more.
Exactly. When teachers spend less time policing behavior and more time actually teaching, they feel supported and effective. The environment changes, burnout drops, and the school saves millions in turnover costs.
And we see that same financial mechanism playing out in healthcare too, right? The report mentions they are partnering directly with chief nursing officers in major hospital systems.
Yeah, and the mechanics in a hospital are very similar. The healthcare system is facing an unprecedented burnout crisis right now. So when Franklin Covey works with a hospital, they train the nursing leadership to create a higher trust, highly communicative environment.
Which leads to better retention.
Right. When nurses feel heard and supported by leadership, nurse turnover drops. But here is how it hits the bottom line. A stable, experienced nursing staff directly improves patient care. And in the healthcare system, Patient satisfaction scores dictate a portion of the Medicare and insurance reimbursements a hospital receives.
Wait, really? So satisfaction scores directly tied to revenue?
Exactly. Better leadership leads to attentive care, which leads to higher patient satisfaction, which literally equals higher hospital revenue.
So the ROI is incredibly clear. 600% better teacher retention, higher hospital reimbursements, helping tech giants navigate the AI transition. But despite all these successes, I found a statistic in this report that honestly blew my mind.
Which one?
CEO Paul Walker mentioned that even within their existing client organizations, Franklin Covey solutions typically only reach about 5 to 10% of the employee population.
Right, yeah.
If this works so well and the ROI is so clear, why are they only reaching 1 in 10 employees? Is the sales team just failing to close the deal?
It's actually quite the opposite. It's not a failure at all. It is a deliberate land and expand model. When they land a massive corporate client, they typically start at the top. They train the C-suite, the vice presidents, or a specific management tier. That accounts for that initial 5 to 10% penetration.
So they get their foot in the door with the decision makers.
Correct. But as the need for enterprise-wide transformation grows, especially with AI requiring adaptability from every single employee down to the front lines, that initial foothold becomes a 90% expansion runway.
They already have the master service agreement signed.
Exactly. The executives already see the ROI. They don't need to spend millions of marketing dollars acquiring new logos to dramatically grow their revenue. They just need to expand the licenses within the walls they have already breached.
Which brings us to the final piece of this puzzle. Let's put ourselves in the shoes of the Franklin Covey executive team. You're looking at your own business. You see a massive secure reservoir of deferred revenue. You see booming, desperate demand from corporations needing AI change management. And you have a 90% untapped market sitting right inside your existing, trusting client base.
It's an enviable position.
It really is. So
Yeah.
what do you do with the massive free cash flow you are generating?
You make a generational bet on yourself. And the capital allocation numbers in this report show a management team acting with absolute conviction.
The stock buyback numbers in this report are staggering. Let's break them down. In Q2 alone, Franklin Covey bought back $17 million worth of their own stock. That's about 947,000 shares taken straight off the open market.
Yeah, it's massive.
Year to date, they've spent $28.1 million on buybacks. But here is the number that truly stopped me in my tracks. Over the last 12 quarters, they have used an astonishing 130% of their free cash flow to buy back shares.
Think about the financial mechanics of using 130% of your free cash flow. Analyst Nihal Chokshi noted on the earnings call that the stock was trading at just 6 times its fiscal 2024 free cash flow.
That's so low.
Management is looking at that deeply discounted valuation, looking at their secure multi-year runway, and deciding that the absolute best return on their capital is not to acquire other companies or pay out dividends, it's to aggressively buy their own company while Wall Street is undervaluing it.
Using 130% of your free cash flow to buy back stock is like taking your entire monthly paycheck plus dipping into your accumulated savings account just to bet on your own future success. That is a loud, undeniable statement of confidence.
Yeah.
They are putting their money exactly where their strategy is.
If you synthesize everything we've looked at today, we are seeing a masterclass in strategic positioning. They are managing the short-term market reactions, like missing an expected EPS target, while ruthlessly optimizing for cash flow. They are locking in multi-year behavioral transformation contracts and, capitalizing on the intense anxiety and disruption caused by the AI revolution.
If you are listening, trying to future-proof your own career, or if you are running a business trying to figure out how to survive the next decade, you should really take a page straight out of this playbook. For years, we've been told that the safest career path was to learn to code, to analyze data, to master technical processes.
Right, the hard skills.
But as those traditional hard skills get increasingly automated and commoditized by artificial intelligence, the paradigm is flipping entirely.
What we used to dismissively call soft skills, leadership, empathy, active listening, change management, and the ability to build and maintain high-trust cultures, those are rapidly becoming the ultimate indispensable hard skills of the future. It is the one terrain where AI currently has absolutely no footing.
We started this deep dive talking about how reading an earnings report is usually just an exercise in skimming dry technical spreadsheets. But hidden in the deferred revenue columns and the free cash flow metrics of this report, we were actually reading a survival guide for the future of human work.
It really forces you to completely rethink what true job security looks like in the 21st century. The value is no longer in being the smartest person in the room, it's in being the person who can get the room to work together.
And we want to leave you with this final thought to mull over today as you look at your own career and your own team. If an AI can eventually write flawless software code, if it can perfectly balance a corporation's financial books, and if it can draft complex legal documents in seconds, will the ultimate irreplaceable job security simply be the ability to look another human being in the eye, get them to trust you, and lead them to execute a shared vision? Something to think about. Thanks for joining us on this deep dive. We'll see you next time.